Welcome to another episode of Can I Retire? This episode is all about reducing your tax obligation on all that money that you have in IRAs, 401ks, 403bs, any money that's been tax deferred. Now, if you love the IRS and you love overpaying taxes, then this video is not for you. Shut the video off right now. I don't want to waste any of your time. But if you want to learn about Roth conversions and if it makes sense for you and your family, then keep watching. We're going to give you some things to think about. Let's jump into this week's hypothetical case right now. I have Ward and June hypothetical. They're both 64 years of age, and Ward's going to live to 92 and June is going to live to 94. So that puts them over 30 plus years in retirement. We want to make sure that this money is going to last and what we could possibly do to reduce their lifetime tax obligation on that retirement funds. So I'm going to click the next button down here. And we're going to take a look at how much money they're going to receive in Social Security and look at their needs, wants, and wishes. Now, their needs, they only want about $6,000 a month to live off of. They're completely debt-free. No mortgage payment, no car payments, everything is paid for. So this truly covers everything that they want to do. The dining out, actually even the traveling, and then they did say that in the near future they're going to want to purchase a car, in today's dollars about $50,000 in 2040. So let's go ahead and keep moving forward and take a look at what their Social Security amount is going to be. And you can take a look here and see that Ward is going to have $3,000 a month or $36,000 a year. June is going to have $2,000 a month in Social Security or $24,000 a year. And they're also going to have about $12,000 in pension. You add those three items up and they come up to right at $6,000 a month, right where they want to be to live off of. They are not going to have to dip into any of their liquid assets or any of their retirement funds to maintain their standard of living. And remember, they're completely debt-free. They have three different accounts. June has $300,000 in a 401k. Ward has $700,000 in his 401k, and then they have some after-tax dollars of $300,000 sitting in a savings account at the bank for a total of $1.3 million of liquid dollars going into retirement, again at the age of 64 years of age. So if I scroll down here a little bit, you can see in this hypothetical case now, we have a house that's worth about $500,000. It's paid for as well too. And if I scroll down to the very bottom, you can see they have a total net worth of about $1.8 million. And remember, they've got enough to live off of the pension and the Social Security, so they're not going to be dipping into those assets. So now that we have the case set up, let's jump over to our next software and talk about the pros and the cons of possibly doing a Roth conversion. So let's start out by talking about the future tax brackets. Currently, tax brackets are set to sunset, meaning they're going to go back to what they were in 2017, in 2026. They're already set to go higher. So let's talk about some things that are happening with the economy. Behind me is our US debt clock. And you can go out to this website and check it out. And currently, as we're taping this, we have over $32 trillion in debt. And we currently, if you take a look at your Social Security statements, you'll see that in about 8 to 10 years from now, they say that the benefits of Social Security will have to be reduced. Now, I don't know if that's going to happen or not. I find that a little bit hard to believe. But for them to fix that problem, I think that most likely they're going to have to raise taxes to cover that deficit. So let me ask you, where do you think taxes are going to be 5, 7, 10, 15 years down the road? Do you think they're going to be lower, or do you think they're going to be higher? Most people say they're going to be higher. And again, if you think they're going to be lower, then this video is not for you. Go ahead and shut it off right now. But if you're the person who thinks that they possibly might be higher, then you better keep watching because we've got a ton of value for you coming up. So take a look at our current tax brackets. Here we are in 2023. You can see we've got a 10% bracket, 12, 22, 24, all the way up to 37%. These are some of the lowest rates we've seen in a long time. So a 12% tax bracket, married filing jointly, a person can make up to almost $90,000. But I want to show you, this is the current tax brackets. This is what they're going to go up to. This is already set in place. Unless Congress comes back and says we're going to reduce it, in 2026, tax brackets are going up. Now is the time to consider doing Roth conversions because they're only going to be more expensive in the future. Now, let me clarify. If you think taxes are going to be lower, or if you need this money in any time in the very near future, then maybe a Roth conversion is most likely not for you. But if you can defer this money and not touch it for a few years, then keep watching. So in 2026, they're already set to go back up. You can see a 12% bracket jumps to 15, a 22% bracket in today's environment jumps all the way to a 25, and a 24 jumps up to a 28, and it just gets worse the farther we go down. Now, I think you'd find this interesting, but back in the late 70s and early 80s, take a look at the tax brackets at this particular time. Look at all of these different marginal brackets that they had. And if a guy made even $48,000 back then, he's in almost a 50% tax bracket. And if he made close to $100-some thousand, a 60% bracket. And the top tax bracket back in the late 70s, early 80s was all the way up to 70%. So my question is it possible that with all the challenges that we have with our national debt, with our Social Security, our Medicare, and all the other programs out there, is it possible that our tax brackets could go higher? And if you believe yes, then now might be a good time to do some conversions, because 70% is pretty ugly. This chart actually shows from 1913, when federal taxes started, all the way out to 2020 of what the top marginal tax bracket was. So if you take a look here, you can see that during World War II, in the early 40s, the top marginal tax bracket was all the way up in the 90% range. And here we are today out in 2023, and if you take a look at this chart, we're currently in one of the lowest tax brackets in the history of time. So again, if you think that taxes might be higher in the future, then does it make sense to do Roth conversions? So one, I got you about doing a Roth conversions that a lot of people overlook that haven't done a lot of them, advisors haven't done a lot of them, is what we call the IRMA warning. And it simply says if you can convert too much money, or if you have too much income, well then some of your Medicare premiums are going to go up. Currently, married, filing jointly can make up to about $194,000, so you can convert up to that amount of money without it affecting your Part B or Part D Medicare system. Not saying that you can't go over it, but something you definitely want to calculate in if you are going to do really big conversions. Just know that there's an extra cost going in to do that. One big warning that I just wanted to point out to everybody. Now, in Ward and June's situation, over that 31 years of their lifetime, they currently have a tax obligation of about $900,000. Now, of course, this is a hypothetical situation, and based on your rates of return and what tax brackets we're converting at and how much we're converting, everybody's situation is completely different. But by doing some Roth conversions and keeping below the IRMA problem here, and the goal is to get those taxes reduced. And so in this particular hypothetical case, we're saving them over $400,000 over that retirement period, that 30 years from the age of 64 up until they pass away. So, in this particular situation, that's a lot of money. We put all of this money into a tax-free place. So current law says that when that money gets pulled out, it is completely tax-free. When they pass away in a Roth conversion, that money is sitting into a Roth for the appropriate amount of time. And someone passes away, it can go to loved ones tax-free. So it can really increase the legacy planning as well too. There's a lot of benefits on Roth conversions, but there's also a lot of confusion regarding Roth conversions. So we wanted to show you a true case sample, hypothetical case, of course, of what it could possibly look like, because most people don't understand that the conversions can save so much money. They think, maybe $20,000 to $30,000 or something like that. But if you truly, want to control your money, you'll leave it to the people that you love, be able to manage it yourself, there's a lot of benefit of taking a look at it. One big reason why I wrote a book called The 10 Tax Commandments, Discover the IRS-approved way to enjoy a tax-free retirement. And we'd love to get you a copy of this if you'd like. You can go out to the website or to Amazon.com and purchase it for $15. We donate all the proceeds to Feeding America. But if you'd like a 15-minute phone visit just to see how your situation looks like, we're happy to do that for you. Just simply reach out or take a look at the description box below. There's a little link down there. You can click on it and get right on the calendar there, answer any of your questions that you may have about this video or any conversion questions you might have. We're happy to help you out. Just go ahead and click on that, pick a day and time that works best for you. But most importantly is always remember to have a financial advisor, an independent advisor, understand what you're doing, what you're trying to accomplish. Always work with a licensed professional who understands your goals and dreams so you are in a good position to enjoy retirement without any problems.